Hello and welcome everyone. Thank you so much for being here with us today. I'm Sam and I moderate these weekly presentations. In just a second, we're going to wait for a couple other people to trickle in, but then we'll be joined by Wesley Boudreau, one of our financial advisors here, and he's going to be leading a discussion on value versus growth, especially heading into the year 2025 and under a new administration. He'll go over that with you guys, and then he will also answer a couple questions. I apologize in advance. We don't always have time to answer every question we receive throughout the presentation, but I will make sure another advisor gets those questions and can answer them for you over the phone or through email after the presentation. I'd also like to let you know that throughout the presentation, you will see some links being entered in the chat. They're going to pop up on your screen. You can click those. They're going to guide you to our calendar as well as our retirement guide and our YouTube and our LinkedIn channels where you can follow us. We post tons of retirement related content weekly, and we really think you'd get some value out of following us, so please consider doing so. And lastly, I would just like to remind you we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of advisors here, so please keep that in mind as you're listening along. And without further ado, let's jump right into it with Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said, we're going to be talking about value versus growth today. A little bit about inflation, how it's affecting both of those potentially. We'll get into why the retirement group kind of leans towards value. Doesn't mean we're 100% value focused, but really, I mean, since our existence, we've always been a little bit more favorable towards value because we're focused on quality investments. And then we'll also talk little bit about how you need to review your portfolio and have a plan, not just in the short term, but the long term, and how it kind of factors into everything with retirement planning that we help with as well. So when we get into it, let's talk a little bit about inflation because that's what's been a hot topic for the last couple of years for everybody. We've come off of a decade where things were kind of slow growth. It was good or bad depending upon how you want to look at it. But obviously, post pandemic, we saw a sharp rise in inflation. You take a look at this chart down here. You can see where that started peaking in the summer of 2022, and it has come down a bit. But again, that does not mean that it's gone away. It doesn't mean that prices are dropping. It just means that that growth of prices has slowed, and that can affect things a little bit differently. If you focus on value companies, it can reduce the value of cash holdings. So let's say a company is sitting on a bunch of cash, their purchasing power has been eroded a little bit. It can also lead to higher cost for businesses and squeeze their profit margins. Now we'll talk a little bit about some companies can pass those on, some may not be able to, some may not be able to quick enough. So again, inflation definitely is something to be aware of that's impacted not just our pocketbooks, but across the board. And we've seen obviously a growth in the market since that inflation has slowed because some of those expectations were baked in there. This chart here, it's a little bit kind of inverted, I guess I would say, when I take a look at it closer. But this kind of shows you the purchasing power over time. In this case, we probably flip it and say that really $3.06 today or in 2020 would have been worth about $100 back in 1900, or really $3.06 back in 1900 would have been worth about $100 today. So it's showing you the purchasing power of that. So your $100 only to buy you about $3 worth of stuff you had back there in the day. $1 back in 1900 would be equivalent to about $37 and change or so right now. But we all have the stories. I've got mine from my grandparents. My grandfather always talking about taking grandma on a date for get a movie and a hamburger and a Coke for a quarter essentially. I can remember going back when I started driving. Gas and crawfish were both 88 cents a gallon and 88 cents a pound. So things obviously change over time, so be aware of that. Now, the inflation and how it can affect value investing and other items, keep in mind that there are opportunities for value investors that when you focus on companies that have pricing power, the ability to actually pass rising costs to consumers. We saw a lot of this as the pandemic was happening. The questions were how much of it was truly being passed on to customers versus how much of it was profit taking. You want to focus on companies that seek out asset-rich companies. So those that have a real value so whenever those commodities or assets they have are in demand, they will continue to grow and meet inflation as opposed to maybe just sitting on cash that would shrink. But a lot of times value companies are cash heavy as well. So there's kind of a happy medium there in some cases. One of the key risks we saw a lot with bonds, obviously, we've always preached about this and talked about it that bonds are coming off that 30 plus year bull run. because interest rates were so low. But what happens is when interest rates go up, your bond prices are going to come down, and vice versa. So if I were to say, let's say I had a bond that was paying 5% a couple years ago, and then if somebody was going to go out and try and buy my bond from me, but the going rate for a bond was maybe 6 or 7%, they're not going to give me my par value back. They're going to give me a discount. So that's why you see and saw in 2022 and into 2023 a pretty severe drop in bonds. But now some of those yields are baked in, and we're getting good performance back out of them as well. The operating cost on some companies that may increase faster than what the revenues are. So again, it may be hard to pass those costs on immediately. It does take time. But some good examples of companies or industries, just so you can kind of see, that would be examples of value. Procter and Gamble, it's a consumer staple company. It has the ability to raise prices on products. We obviously saw this during the pandemic. ExxonMobil, ConocoPhillips, Chevron, all those different energy companies, they can benefit from rising commodity prices. They'll go hand in hand with the oil prices. Johnson Johnson, or any type of healthcare companies, typically that's inelastic demand for essential products. You can't go without your medication or potential surgeries and things like that and stuff. So a lot of those products are I want to say immune to inflation, but can are still needed, and you have to utilize those. So get into value investing. I'll summarize it very simply. A lot of this is something that you would instill in your kids and kind of help help raise them and tell them to kind of focus on being value when it comes time to buying things and stuff. Something we employ as well when we go out shopping. If we're buying a dress or buying a TV, we tend to shop for it versus just saying, "Oh, that's the best one," or "That's the high, that's the." Let me go back and say what was the broker, like the Furbies and things like that. Different things that are hot. That's really what you're going to see a lot of times with growth investing. But with value investing, you're going to focus on reviewing everything, digging deep into what the true value of a stock is, or the fund managers utilizing are going to do that, and then that's where they're going to invest, not just look at the high flying growth stocks. So again, investment strategy is focused on buying undervalued assets. So again, that comes with research, and that goal there is to capitalize on market inefficiencies. Not everybody's doing the same research, so your goal is to hopefully truly find that intrinsic value of a company, and then just go out there and look at what it's trading at. If you think it's worth $100 a share and it's trading at 120, then you stay shy of it. If you think it's worth $100 a share and it's trading at 85 or 90, then you think that that's got intrinsic value and it can come back up to that $100 a share. It may not be immediate, it may be slow, but that's definitely kind of the overview of value investing when you're looking at individual stocks at a time. So again, it focuses on long-term wealth creation. Look at Warren Buffett. He's a great example of a steadfast value investor. You focus on intrinsic value, I mentioned as well, and typically you have lower risk through that analysis because you instead of just buying something that's hot, you're learning about that company. You know that company, and again, if your research is correct and you think that value is correct, then you're hopefully buying at a reduction, so you get that margin of safety we'll talk about here in just a moment. So some of the key principles to value investing, intrinsic value, we talked about that a little bit. So the assets, so assess the true worth of a company. Again, do your research. We're kind of beating this to, to death, but use tools like discount cash flow. So again, we're looking at the actual cash flows coming in. So a lot of times a growth company, you'll see startups that aren't making any money. They may not make money for a while, but people are so gung ho, and there's private equity firms putting money into them to kind of get them afloat and get them started. You go back to the dot-com era. Whereas a value company is going to be consistently earning money, and it may be that they're later in that life cycle and they're paying higher dividends because they can't turn around and reinvest that money quickly enough. So again, focus on that. You want to look at also margin of safety. I mentioned that. We'll talk a little bit about it later, give you kind of a chart as an example. But you want to buy at a significant discount to the intrinsic value, not just a little discount, but a significant. So that way, even if you made some mistakes, you've got a little bit of a buffer in there as well. Patience, it does take time. Some cases you have to hold these investments for longer periods than just going in and out of a growth stock. So be aware of that. But a lot of times it makes it easy. It's kind of a buy and hold approach. And then fundamental analysis, again, evaluate the financial health, the management quality, and the competitive advantage that each company may have. And again, a lot of these things I'm talking about for saying you can go and do, but a lot of times most of us are going to rely on the expertise of investment managers to do this, whether it be in ETFs or mutual funds or separately managed accounts. So again, just we want to be aware that that's what they're doing on a day-to-day basis and trimming those down. As far as the value stocks and identifying specific stocks. Again, this is something probably a manager is going to do, maybe not yourself, but some of the key metrics to look at. These first three are you going to be looking for lower metrics, so a lower price to earnings ratio, price to book ratio, and debt to equity ratio. So again, you want a company that's not overvalued. You want a company that's not taking on too much debt. It's earlier in the cycles. You want it late in the cycle, and you want a high free cash flow. So again, they're consistently generating revenues, and we know it's coming in, and we look at that discounted cash flow analysis we talked about before. Some qualitative factors, again, a strong management team. So analyze what they're doing there. Sustainable competitive advantage. So a lot of times we call companies with moats. They've kind of built a moat around them, and it's hard for competition to come in there. And you look at their industry position and their growth potential. So again, a lot of these times the value companies are big in the industry. They've been there for a while. They may still have some growth potential based on acquisitions and things like that, but a lot of times it's going to be that steady growth we're looking at. I mentioned before the margin of safety. This is kind of a quick chart or as an example. So if we look at the value of shares going up and down, we look at this little dip, if you would. Assume that that's the stock market or that's the actual valuation of a stock that's come down below what you think the intrinsic value is, or the manager thinks the intrinsic value is. That line coming straight across, that's going to be the intrinsic value. So if again, the example I gave before, I think I said you figured out it's worth $100 and it's growing steadily. But in this case, maybe it was trading at 110. So you said, I'm not going to do anything. It maybe dropped down to 95, 90, then 85. And you said, okay, that's where I'm comfortable. That's a big enough margin of safety that I'm going to go and buy it. That's my buy zone. Yes, it could go a little bit lower, but I've got some margin built in there. So it's not going to affect me as much. And it's just going to take some time for it to get back up to that intrinsic value. And that's where you're making your money off of that specific value stock. And as far as the buying zone versus overvaluation, because what's going to happen is, a single stock is going to go through different phases. It's not always going to be a value a company. A lot of times, generally speaking, it'll start out as a growth and then become a value. But in some cases, it could get overvalued because people think it's hot for some reason, or there's something a new acquisition that slows back down. So in this chart here, if we take a look at that red line is going to be the intrinsic value that you've estimated to be. The blue line, we see, is going to be going up and down a little bit more. That's the actual stock price of it. So in this case, that dotted line you have on there, that's maybe your margin of safety, zone that you're thinking. So maybe you got a 10% or a 15% buffer that you're saying, hey, if it drops below what I think it's worth, I'll buy it, but not until it drops below maybe 10 or 15%. So in this case, you see this moving around, and at some point, that blue line comes below your margin of safety. So you say, great, I'm going to buy it, and then you'll hold on to that and it gets up to your intrinsic value. And once it gets to that point, now keep in mind you're adjusting your intrinsic value and your valuations all along the way. So, but if it gets above where you are, then that's where you say, okay, it's getting too expensive. I'm gonna get out of it. I'm not going to actually buy it at this point in time. So I'll actually sell it. And you could just wait and go through that cycle again. You sell it. You look for something that's got good value. And this is why you'll see a lot of times some of the value managers we use at the retirement group maybe sitting on a pretty good pile of cash because they're not going to buy just to buy. And we focus on managers a lot of times that aren't required to be fully invested. Sometimes you can have a mutual fund, for instance, that the prospectus says they have to be 98 or 98.5 or 99% invested. So even if that manager woke up the next day and knew what was happening to the market and didn't want to be in it, he still has to be in it because the prospectus says so. So a lot of times, if you got a true value manager, they may be sitting on a, 10, 20, 30% stock, excuse me, 10, 20, or 30% cash position, just because they're looking at it and say, look, there's nothing worth buying right now. So we saw a lot of that prior to 2020, and then we saw the ability to deploy that cash in 2020 when a lot of those stocks dropped based upon the pandemic, well into the buying zone in this example. So some of the investing differences between value and growth. Again, value investing highlights are focus on undervalued stocks. We've talked about that. That tends to lead to lower risk in some cases. The dividends are often available. Again, a company that's paying dividends a lot of times means they think that you can do better with that cash versus them reinvesting it. So a lot of times those are companies that have been around a while. They're potentially slowing down. But again, when their stock price drops, then that dividend yield goes up as well. We saw a lot of this during the pandemic. And then a lot of times, like I said, they're stable and mature companies. On the flip side, if we compare it to growth investing on that right side there, just the opposite. Growth companies are going to be higher growth potential, but also higher loss potential, higher risk. Dividends are less common in those, and a lot of times you're emerging and fast-growing companies. So a lot of times your small cap or startups. Again, going back to examples of the dot com or a lot of technology and things of that nature as well. So some of the advantages of value investing, again, this is kind of repetitive what we talked about before, but lower volatility tends to be stable returns in uncertain markets. So if we have a position where the market's suffering, it's not immune. You're still going to see some downs, but not as much as what a growth stock would suffer. But on the flip side, when the market rebounds, the growth may rebound a little bit quicker. But again, you know that you're at worst case scenario, everything held equal. If you got a company paying 5% dividends, you know you're at least getting the dividends there. And so that dividend income creates regular cash flow. A disciplined approach encourages thorough analysis. So make sure, again, you or whoever you're working with has thorough analysis in those underlying company stocks. And typically, there's a proven track record. We don't have the charts on here. We've had in some of our other webinars, but historically, value does outperform growth over various markets. It hasn't done so quite recently, but again, there's always ebbs and flows. They come in and out of favor, and so we may see that change here moving forward. But over a long-term period, value has outperformed growth. So in conclusion, some of this value investing, it is a discipline improving strategy. So historically, like I said, it's actually outperformed growth significantly. You need to focus again on fundamentals and the intrinsic value, and be patient and think long term. So again, we talk about that intrinsic value, that margin of safety in the buying zone, and you're waiting for that to get back up to what you think it's worth. That may happen in a couple weeks. It may happen in a couple years, or you may hold on for a longer period of time. And again, that doesn't mean that you're just buying and holding one specific stock. You're constantly evaluating this. There may be others that have a better margin of safety, or a better delta between that and their intrinsic value. So again, this kind of factors in the entire portfolio build just for the value sector alone of a portfolio. And so the next steps, evaluate your investment goals. So if you want to take a look at your 401k, see how you're invested there or your other accounts, let us know. We can do a deep dive, show you what your breakdown is between your large cap, small cap, mid cap, growth versus value, blend it. We can also look at the international side, kind of give you a full look under the hood, if you would, and kind of open that up for you. Start identifying undervalued stocks if you're doing this on your own, or work with companies that do so. And then obviously contact us if you want to run a review or dig deeper into this. All of our services on that review side are complimentary. So again, we can give you the analysis of what you're doing right now. Worst case, we're going to come back and tell you you're in good shape. This is what you're doing, what you're saying, or we might uncover some items that you need to either attend to on your own, or work with us, or work with somebody else to potentially fix, and we'll go over that with you. But that also leads into the overall long-term planning aspect, where we're really focused on helping individuals at Fortune 500 companies retire and retire appropriately. So right now, about three-fourths of Americans over 50 don't have a written plan. If you can spend a little bit of time with us, we can put together a financial plan or a cash flow analysis for you to kind of tie all this in, let you know where you stand on retirement. If you tell me, hey, Wesley, I'm looking at retiring in 5 years, have I saved enough? We can run those numbers and show you here's how everything looks. Let's dig into your actual company benefits. Does it make sense to retire in 5 years? Should you work longer to get more vesting for a pension, or could you go sooner? We can run through all those different iterations of a financial plan with you. And that's all complimentary, just obviously with the hopes that when you do decide to retire, if you need help outside of doing things on your own, you put our hat in the ring when it comes time for interviewing people. We can definitely show what we can do there. So again, a quick reminder, for those of you that have not worked with us before or talked with us, the Retirement Group, we are an independent financial advisory firm that focuses on working with corporate employees, helping them transition into retirement. Most of our advisors focus on just a select few companies, so it allows us to have a deeper understanding of your benefits plans, whether it be the 401k, pension plan, if you're lucky enough to have one, healthcare, retiree medical benefits, life insurance continuation, things like that. We can dig into all those on top of the investment strategies. And also, we have offices throughout the country, so rest assured, if you need to sit down with somebody face to face, we can likely accommodate that. But obviously, this day and age, we can do web meetings, phone calls, emails, whatever your preference is. And then that cash flow analysis I mentioned, that's complimentary. Do take us up on that. Spend at least 10 minutes getting some data. We'll spend 10 minutes getting some data from you, maybe more if you don't have all of it. Give us a couple days to put a full report together, and we'll sit down, go through that. And if it's been over a year or two since you've done one with us, give us a call again, because a lot's changed in the last couple years or so. Between inflation, the stock market, and so we can review that again and update that. So with that, I'm going to kind of wrap this up, and then I think we saw two questions come in. We'll knock those out. But if you want to schedule a meeting with myself or any of the other advisors here in the offices, you can call us at 800-900-5867. You could also use the email info@retirementgroup.com. We've got a couple QR codes here on the screen you can use. Once they get into our LinkedIn, if you want to follow along with us on LinkedIn and get updates on different webinars like this and more company specific information sometimes. And then another one, if you want to get into our schedule, if you want to schedule a call with myself or somebody else in the office, we can do that as well. So some of the questions I got, one coming here. Are you saying I should move my 401k to value? So let me reiterate that. No, that's not what we're saying. We're talking about kind of the difference between value and growth, and kind of the fact that we have a slant towards value. It doesn't mean we say let's go all in value or all in growth. That gets into market timing. But again, a truly diversified portfolio is going to have, value, growth, a blend, large cap, small cap, mid cap. So it's going to have a lot of those different things. We got to focus on international bond exposure. So really, the best way to kind of get into this, and if you want to see, is let us get a statement, a copy of a statement, or a list of your holdings in your 401k or other accounts. If you want to look at those too, we can run an analysis, show you exactly, what percent you got in value versus growth. We can potentially dig deeper. One of the things I didn't really talk about, I mentioned management and stuff. You gotta be careful. If we go back to the late 90s and early 2000s, there were a lot of value managers that got hammered with the dot-com crisis as well because they drifted. They didn't stick with what they said they were. So you gotta be careful, make sure it's truly a value manager. So a lot of times what happened was they saw, all the growth, and they were getting tired of getting beat, year after year. So they started dipping into some of the dot-com at the higher prices as well. And so what happened is when that market came down, they came down with it. So it really exposed them, and you're able to find out who truly has that record or so as well. And then another question here: are all value companies big companies? So that kind of piggybacks that a little bit. I know it sounds like I talked about that being the case because I talked about, companies starting up, growing, and then kind of slowing down. A lot of the value companies are bigger companies because again, they've built up their clientele base, they've built up their company, and they've got a consistent continuation of their dividends. But that's not all. There's a small cap value, mid cap value. Again, predominantly you're going to have more growth exposure in mid cap and small cap, but there are definitely some small and mid cap companies. Not every company starts off small and turns into some big behemoth. They stay small, or they go from a small to mid cap, or they may even have it might be a mid cap company that spins off and splits a company, and now they have two small caps. So there are some different things to be aware of there. And with that, I want to thank everybody. And hope you guys have a great day. And again, a quick reminder, even though we work extensively with a lot of your companies, does not mean we are employed by them or endorsed by them. But should you have any questions, feel free to reach out, give us a call, and we'll be happy to dig into that for you. So thank you, and we hope you have a great day.